Gross margin is not what most people think, but it does have one important purpose. Put it to work on the one thing it does best. Welcome back to the Profit Tips Library. In this video, I want to talk about gross profit margin, or margin. Gross margin is calculated by dividing the gross profit into the revenue on the sale. This gives a percentage that indicates how much of the revenue is left after the product is paid for. Margin is probably the most widely used and the least understood metric in wholesale distribution. Much of what we've been taught about the use of this metric is wrong, and this has been very detrimental to the success of almost every company. Frankly, margin is an absolutely lousy indicator of profitability because you can have a high margin sale that makes you a lot of money, a high margin sale that makes you no money, or a high margin sale that loses you a lot of money depending on what the expense rate is on the sale. If you're a numbers guy like I am, it's pretty easy to visualize this. In the random chance of all the sales that come through the business, you'll have margins that run anywhere between, say, 10% and maybe as high as 50% or more. However, you'll have expenses or cost of service for those sales that can run anywhere between near zero and 200, 300, and 400% of the revenue on the sale, depending on the size of the sale and what kind of resources are consumed in delivering the product into the customer's hands. So if you think of yourself as reaching into a margin bucket and coming out with a ball that has some number between 10 and 50% written on it, and then reaching into the cost bucket on the other side and coming out with a ball with somewhere between 0 and 300% on it, what you'll find is that too often the cost rate on the sale is higher than the margin rate on the sale, in which case the sale loses money, regardless of what the margin number is. And in wholesale distribution, more than 60% of the sales have costs that are higher than the margin. In this dynamic is the secret of some of the most successful companies in the business. Companies that generate 2, 3, 4, 5, or more times the profit rates of the average company. So what does margin really mean? When we took a long look at what margins mean to our clients, margins are actually a measure of how effective the company is at setting the price on their product. It basically says how much above the cost of the product are they able to charge the customer for the product. And of course, this differential needs to cover all the expenses of the company, pay for the salesperson, and provide a bottom line for the company. For this reason, the best companies have adopted NBC as the metric that they use to determine the value of a sale, the value of an account, or the value of a territory. These companies use the margin rate for what they should, an evaluation of how good the sales rep or the sales force is at obtaining a positive price for the product. For this reason, top companies use the margin metric in the way that it should be, to evaluate the effectiveness of the salesperson and the sales force at obtaining an optimum price for the product. We'll talk about the things that you can do with this information to drive higher profitability in other videos. The takeaway from this? Teach your entire organization the proper use of margins and switch them to using NBC when they're trying to assess the value of what they're doing. If you'd like to know more about the sophisticated analytics that help our clients outperform, well, just about everyone, visit our website at waypointanalytics.com.